Have you seen those headlines about Canada's out-of-control housing prices? How the average home in Toronto or Vancouver costs over $1 million? How Canada now has some of the most unaffordable real estate on Earth? Well, today we're going to break down exactly what's going on in Canada's housing market, why prices have skyrocketed to insane levels over the past 10 years, and why many experts warn that Canada's epic housing bubble could soon pop. I'm talking a massive housing crash, the likes of which Canada hasn't seen in decades. Now, when most people picture a housing bubble, they probably think of the 2008 crisis in the US. But what's happening in Canada right now is actually much crazier. Real estate prices in Canada have doubled, even tripled over the past 15 years. The median price for a detached home in Greater Vancouver recently hit a ridiculous $2 million. In Toronto, it's $1.8 million. To put things in perspective, those amounts exceed what a typical family makes over 15 to 20 years of working. An entire lifetime of savings wouldn't be enough for the average Canadian to buy a basic detached home today. And yet, housing prices keep breaking records month after month. Clearly, something isn't right here. Fundamentally, there's no way average Canadians should be this priced out of the market. So how did housing affordability in Canada spiral out of control so fast? Why are prices detached from local incomes? And what could Canada's historic housing bubble bursting mean for homeowners and the economy? Stick around as we uncover the truth behind Canada's extreme real estate mania. But before we continue, we would like you guys to subscribe to the channel, like this video, and hit the notification bell icon so you do not miss out on any amazing and entertaining content. Around the time the U.S. was grappling with the aftermath of its housing bubble collapse during the Great Financial Crisis 15 years ago, Canada found itself caught in a different narrative. In response to the U.S. crisis, the Federal Reserve slashed interest rates to historic lows. Swiftly following suit, Canada's central bank, the Bank of Canada, dropped its own rates to rock bottom. The interesting twist: unlike the U.S., Canada wasn't in the throes of a financial crisis. Its banks were stable, and the economy was humming along just fine. Now, the decision to mirror the U.S. in slashing interest rates may raise eyebrows. Did Canada really need to take such drastic measures? Regardless, the die was cast, and mortgage rates plunged to unprecedented depths. This, in turn, handed Canadian homebuyers an unprecedented advantage. Think about it. Lower mortgage rates mean less interest paid on loans, translating to increased buying power. Canadians suddenly found themselves in a position to splurge on more expensive homes. Predictably, this led to a surge in house prices. Essentially, the Bank of Canada inadvertently supercharged the housing market, setting off a bubble that seemed to inflate endlessly. But that's not the only force at play. Canada's major cities, particularly Toronto and Vancouver, became hotspots for foreign investors, especially from Asia, notably China. These investors weren't just buying properties, they were gobbling them up without even setting foot on Canadian soil. The goal? Parking their wealth where the long arm of the Chinese government couldn't reach. However, it wasn't just wealthy investors contributing to this craze. Canada's lax regulations regarding real estate ownership made it an attractive destination for those with less than savory intentions. Enter the world of money laundering, where criminals found Canada's weak regulatory environment a convenient playground. You could buy a home under a numbered corporation, keeping ownership details shrouded in secrecy. Banks were supposed to flag suspicious large cash transfers, but the allure of real estate profits seemingly blinded them to the origins of the funds. Yet, it wasn't a purely foreign-driven affair. Domestic investors also joined the fray, adding fuel to the already blazing housing market. Real estate emerged as a star performer, outshining traditional investments like stocks and bonds. The allure of better returns prompted Canadians to shift their funds from investment accounts to real estate, where second and third homes became prized acquisitions. Renting out these properties further fueled the surge in housing prices, creating a self-perpetuating cycle of growth. And then came the COVID-19 pandemic, casting a shadow over Canada's economy as lockdowns and business closures froze activity. In response, the Bank of Canada took a familiar route, slashing interest rates to rock-bottom levels. However, this time they added a new dimension to their strategy. They began acquiring mortgages directly from lenders using freshly printed cash. Empowered by this influx of funds, mortgage lenders extended new loans at historically low rates. In 2020 and 2021, securing a mortgage in Canada with an interest rate below 1% became a reality. This financial infusion propelled the housing market to unprecedented heights within a short span. Throughout the pandemic, numerous Canadian cities witnessed housing prices skyrocketing by 50% or more. However, beneath the surface of this financial manipulation, the exploits of speculators, organized crime, and the absorption of housing supply by investors, another critical issue loomed large: a shortage of homes. It may seem paradoxical for a vast country like Canada to face a housing shortage, but the reality is stark. Canada boasts the lowest housing supply relative to its population among G7 nations. To reach the average housing quantity seen in countries like the US and Britain, Canada would need to construct a staggering 1.8 million homes, a colossal undertaking for a nation of 40 million people. For generations, Canada stood out as one of the most economically accessible countries in the developed world. Despite surges in population due to robust immigration, the cost of housing remained remarkably stable over the years. Sure, there were occasional bumps along the way, but by and large, housing in Canada was within reach for generation after generation. Canada, with its vast expanse, had the luxury of abundant space, and its cities could effortlessly expand to meet growing demand. What's more, both the federal and provincial governments played a significant role in the housing sector. They subsidized apartments for low-income families and facilitated the construction of homes for the middle class. Canadian government guaranteed loans to developers and even had a catalog of pre-approved home designs, making the construction process more efficient. However, this golden era underwent a shift in the 1990s. Faced with a monumental debt crisis, Canada's federal government scaled back housing subsidies. From that point on, the country essentially stopped constructing homes for low-income families. Simultaneously, municipal governments across Canada began viewing housing as a lucrative cash source. Year after year, decade after decade, they hiked development charges on new homes, essentially taxes levied on developers. For instance, in Toronto, a new single-family home today comes with a staggering developer fee of $137,000. Developer fees soared and new housing builds dwindled. But that's not the only transformation Canada witnessed. Cities started imposing restrictions on urban sprawl, curbing the construction of new homes on the outskirts. Vancouver now boasts an urban containment boundary to shield its surrounding farmland from conversion into housing. Similarly, the Toronto metro area introduced a green belt, protecting wilderness and farms, but severely restricting housing development. With space within these restricted zones running out, developers turned to existing neighborhoods. However, this sparked a new set of challenges. Residents in these areas resisted infill development, where apartment buildings punctuated single-family home landscapes. City councilors often sided with these residents, making infill development a formidable challenge. Consequently, developers redirected their focus to old industrial lands, warehouses, unused rail yards. Yet, these areas proved suitable mainly for high-rise apartments, leaving the dream of single-family homes in the background. The changing landscape of Canada's housing story, marked by financial shifts, governmental decisions, and community dynamics, reveals a complex tapestry in need of innovative solutions. Over the past decade, the construction of single-family homes in Canada's major cities has taken a nosedive. In places like Toronto, the landscape is transforming. There are hardly any new single-family homes being built. The hitch? Despite this shift, people still yearn for the charm of a detached home where kids can play in the backyard. For generations, Canada has been a haven where children grow up in homes with ample space. However, as the construction of new detached homes dwindles, prices shoot through the roof. The average price of a detached home in Greater Vancouver now hovers around a whopping 2 million Canadian dollars, or roughly 1.5 million US dollars. In Greater Toronto, a single-family home comes with an average price tag of 1.8 million Canadian dollars, translating to about 1.3 million US dollars. For families that snagged homes a generation ago when prices were in the mere hundreds of thousands, This spike has been a windfall. But for those attempting to step into the housing market today, it's nothing short of a disaster. To exacerbate matters, the extensive money printing by the Bank of Canada during the pandemic inevitably led to inflation. To counter this, the Bank of Canada initiated a series of interest rate hikes in early 2022, and the surge hasn't let up. The rate on a mortgage in Canada soared from as low as 1% in 2021 to approximately 6% today. In simpler terms, the interest owed on mortgages has surged six-fold in less than 2 years, a financial tidal wave set to impact every Canadian mortgage borrower. Unlike their counterparts in the U.S., Canadian mortgages don't typically last 30 years. Instead, they typically span 3 to 5 years and then must be renewed at a new interest rate. Amid the pandemic, variable rate mortgages, which fluctuate with the economy, seemed enticing with lower interest rates compared to fixed rate mortgages. Around a third of Canadians today have opted for variable rate mortgages where the interest rate can oscillate monthly. However, when the Bank of Canada began its rate hikes, one-third of Canadian mortgages instantly became more expensive. Additionally, all remaining fixed-rate mortgages are set to expire within 5 years, meaning even those with fixed rates are compelled to refinance at significantly higher interest rates. Families across Canada find themselves tapping into their savings just to make ends meet, all while attempting to steer clear of a housing crisis reminiscent of the U.S. In response, Canadian banks devised a unique strategy. They decided to extend the length of mortgages. This move aimed to reduce monthly payments for mortgage holders, but it also meant prolonging the lifespan of these mortgages significantly. With borrowing amounts reaching staggering heights, many Canadians now find themselves shackled to mortgages spanning 70, 80, or even 90 years. In essence, they've become debt slaves. At this point, you might be wondering, with all the warning signs flashing red hot and experts shouting bubble warnings from the rooftops, will Canada's epic housing boom finally end at a devastating bust? Or will prices defy the doom and gloomers by staying high or even continuing to grow? It's the million-dollar question. Well, make that the multi-million-dollar question in Canada at least. You see, despite all the mania and exponential growth over 20 years, Canada has yet to suffer a significant national housing downturn. Prices just keep defying gravity. And that breeds a certain irrational optimism that this time won't be different. But if you look closely at the fundamentals and the market dynamics, there are good reasons to believe the tides are shifting towards an inevitable correction. Here are a few arguments for why Canada's real estate bubble must finally burst. First, affordability has crossed into the danger zone. Based on the benchmark that housing should cost no more than 3 times household income, Canadian real estate blew past rational pricing years ago, with detached homes in Vancouver and Toronto now clocking 12 to 15 times what average families make, clearly outside the bounds of sustainability. Second, with rock-bottom interest rates officially over, monthly carrying costs are set to skyrocket for recent homebuyers. Anyone who purchased during 20 or 2021, when variable rate mortgages dipped below 1%, faces massive payment hikes in the next renewal. As rates keep normalizing, more stretched buyers will default, triggering forced sales. Third, government intervention, which helped fuel the mania, has firmly shifted into reverse. Regulators are explicitly warning against extending amortizations, and ending pandemic supports means no more backstopping the market. Without emergency buyer aid or loose bank lending, demand is drying up rapidly. Finally, the psychological mania of the last decade appears to be cracking. From home flippers getting burned to reduced competition at auctions, the fear of missing out finally faded in 2022. And once sentiment sours for good in a speculative frenzy, prices have nowhere to go but down. Now, the counter-argument says Canada's housing shortage, constant immigration inflows, and precedent of resilience protects against any 2008-style crash nationally. Supply-demand imbalances may cushion the fall to some degree, but with local prices already totally disconnected from any reasonable metrics like incomes, construction costs, or rental rates, the notion that real estate will continue defying financial gravity seems fanciful. The herd mentality says this bubble can keep inflating indefinitely. But fundamentals and economic history scream that what goes up this disproportionately eventually comes back down to earth. It's likely not a question of if Canada's housing boom turns to bust, but how soon and how painful the downswing proves. So, while exact predictions are tough, don't be surprised when today's real estate euphoria transforms into tomorrow's fear and regret for recent buyers. What we covered confirms Canada's epic housing bubble is ripe for popping. And when this party finally ends, the hangover for Canadian debtors and the economy promises to be excruciating. And there you have it, the story of how Canada's epic two-decade housing frenzy bred one of history's most extreme bubbles. Fueled by cheap debts, foreign money, and nonstop government aid juicing demand. But after years of crazy, disconnected growth, the party finally seems to be ending. Now, the only question is, how bad will the hangover be once this bubble truly pops? Some analysts warn we could see prices crash by 40, even 50% in cities like Toronto and Vancouver before finding a bottom. Do you think Canada's housing market is headed for a sharp correction? How big of a crash are we talking? And how do you see this impacting the broader Canadian and even global economy? Let us know in the comments down below. Be sure to like this video if you learned something new, and subscribe to the channel for our best content on economics, housing bubbles, investing trends, and more. Thanks everyone for watching, and see you again soon.